All right, let's get right into it. We're tackling a huge question in finance today. When your investment takes off, is that because your manager is a genius, or did they just get lucky? We're going to break down how the pros tell the difference between real skill and just, riding a massive market wave. This is going to be fun. So let's kick things off with the big problem, the thing every single investor has to wrestle with, whether you're just starting out or you've been doing this for decades. And here it is, the million-dollar question. Is your portfolio manager actually a genius, or did they just get lucky? I mean, think about it. It's so easy to look brilliant when the whole market's going up, right? But how can you really be sure you're paying for genuine expertise and not just an expensive seat on a rocket ship that everyone's already on? For the longest time, risk was just this fuzzy, kind of scary idea. It wasn't something you could pin down. But then modern finance came along and decided to tackle this exact problem. The goal was to turn risk from this abstract ghost into something you could actually measure and analyze. And honestly, that changed the game completely. So what they came up with is this really elegant framework that splits your returns into two key parts. First, you've got beta. Think of this as riding the market wave. It's the return you get just for being in the market. Then you have alpha. This is about beating the market wave. This is supposed to be the pure skill your manager brings to the table. Okay, so now that we have the concepts, how do the pros actually decode this stuff? Let's get into the nitty-gritty of how they measure and think about these two critical numbers. Let's start with beta. So think of beta as a way to measure how sensitive your investment is to the market's mood swings. It's what we call systematic risk. It's the risk that's baked into the whole system, the kind you can't just diversify away. So to put it simply, beta basically tells you how volatile your investment is expected to be compared to a benchmark like the S&P 500. It gives you a baseline. Is your stock going to be more jumpy than the market? Less jumpy, or move pretty much in line with it. And interpreting the number itself is pretty straightforward. If you see a beta of exactly 1.0, that means your stock is expected to move right in lockstep with the market. A beta above 1, well, that's considered aggressive. It's going to be more volatile, which means more risk, but hey, also more potential reward. And anything below 1 is seen as defensive, a bit more stable and less rocky. And this really clicks when you look at actual companies, right? High-growth tech stocks, luxury brands, they tend to have high betas. They soar when the economy's booming, but they get hammered in a recession. On the flip side, you've got companies like utilities or food manufacturers. People always need to keep the lights on and eat, so those stocks are way less volatile. That's a classic low beta. All right, so that's beta. Now for the really interesting part, alpha. If beta is the return you get just for showing up and taking market risk, alpha is, well, it's everything else. It's the slice of the return that can't be explained by the market's movement. In a perfect world, this is the pure, unadulterated skill that a manager adds by picking the right stocks at the right time. But here's the catch, and it's a big one. When you look across the entire market, alpha is a zero-sum game. For one manager to find positive alpha, another manager has to have negative alpha. Someone wins, someone loses. And when you factor in fees, it actually becomes a negative-sum game for investors overall. This is exactly why finding real, consistent alpha is so incredibly difficult. Okay, so you think you've got it figured out, right? Beta is the market, alpha is the skill. Simple. Well, here comes the plot twist. For a long time, this was the accepted wisdom, but then some really smart people started digging a little deeper. See, for decades, the standard model, you might have heard of it, the capital asset pricing model, or CAP, it showed that market beta explained a huge chunk of a portfolio's returns. We're talking like 70%. And that was a massive breakthrough. But it left this giant 30% chunk totally unexplained. And for years, everyone just shrugged and called that 30% alpha, chalking it up to manager skill. But a few researchers started asking a really important question. What if it's not skill? What if there's something else going on, something systematic that we just haven't figured out yet? And that question led to an absolutely groundbreaking discovery. Researchers like Eugene Fama and Kenneth French found that a huge piece of what we were calling alpha was really just exposure to other predictable risk factors, or hidden betas. For instance, they found that historically, portfolios that consistently bought smaller companies tended to do better. Same with portfolios that bought cheap, undervalued value companies. It wasn't some manager's random stroke of genius, it was a repeatable strategy you could bottle up. And this discovery basically gave birth to the entire smart beta industry. The logic was powerful and simple. If you can systematically capture these factors with a set of rules, why on earth would you pay a manager high fees to do it? And just like that, smart beta ETFs were born, designed to package up these hidden betas into low-cost products. And that, my friends, blurred the line between passive and active investing forever. So, armed with all this new knowledge, how do the pros actually put these pieces together to build smarter portfolios today? Let's take a look at the modern playbook. Well, one of the most popular and, frankly, powerful frameworks they use is called the core satellite strategy. It's a really smart way to take everything we've talked about, alpha, beta, all of it, and apply it directly to how you build your portfolio. The whole idea is to split your portfolio into two main parts. You have a massive, stable core that makes up the bulk of your money, and then you have a few smaller, more specialized satellites that kind of orbit around that core. So here's the breakdown. The core is your workhorse. It's the vast majority of your portfolio, maybe 70 to 90%, and it's invested in low-cost index funds or ETFs. Its job is simple: capture the market's return, your beta, as cheaply as possible. Then you have the satellites. This is the smaller, more adventurous part of your portfolio. This is where you place your high-conviction bets, where you might give money to an active manager you truly believe in or invest in a niche strategy, all in the hunt for that elusive, genuine alpha. All right, let's pull all of this together, because getting your head around alpha and beta isn't just about the math. It's really about a fundamental mindset shift in how you approach investing. And this, right here, is probably the most important takeaway of all. The amateur, the gambler, they just look at their final return and ask, how much did I make? But the professional thinks differently. They ask a much smarter question. What return did I get for the amount of risk I took? See the difference? It's all about evaluating the process and the risk-adjusted performance, not just the final score. And pros don't just wing it either. They use statistical tools to make sure their analysis actually holds water. One of the key ones is a metric called R-squared. In simple terms, it tells you how well your chosen benchmark, like the S&P 500, actually explains your portfolio's ups and downs. If that number is high, say 0.85 or more, you can be confident your alpha and beta numbers mean something. If it's low, the whole analysis could be garbage. And that leads us to a really fascinating question for the future. I mean, think about the journey we've been on. We went from thinking skill was everywhere, to discovering these hidden market factors, to then basically turning those factors into low-cost products. So as AI and technology get even better at sniffing out every single systematic pattern, where will true human skill even hide? What will alpha even mean in a world like that? It's something to think about.